Discussion. So, good afternoon. Good afternoon. Thanks. I've been asked to give you a presentation regarding case studies for success, and that's a really broad subject. So I picked 4 areas to present today. The areas are record retention, cash flow management, internal controls, and business plans. I'll attempt to make the subjects interesting by telling stories that I feel relate to these areas, but first I need to tell you a little something about me. My name is Bonnie Swanson, and I am a CPA, and I work for Wilkerson Guthmann as a senior tax manager and a team lead in their business growth group. I have been with Wilkerson for over 10 years. I also worked in Duluth for 5 years for Hanson House Company as a tax manager and audit lead and the only employee in their business consulting group. Prior to that, I was employed by Expedex, which is an arm of International Paper, and I was in the purchasing and inventory department. Besides that, I am the sole owner-operator of Still Life Taxidermy, and I have had the business for 22 years, and for 6 of those years it was a commercial operation with a storefront and employees in Forest Lake, Minnesota. I had an unconventional journey into public accounting. I started working when I was 15 as a waitress, and soon was helping the owners with bookkeeping. Since then, every job I have ever had eventually would evolve into me maintaining their books. Some of my coworkers to this day tease me. They wonder what job I did not have, and I like to say that I'm working my way up the alphabet. I started with waitress, I was a taxidermist, and I was into taxes, and maybe someday I'll be a professor, excepting I think retired does come before that, but I will continue with that whole process. My years of working have given me an intimate exposure and hands-on experience with many different industries, and that in turn helps my relationship and my clients at this professional level. As I previously said, I picked 4 areas to focus on for this presentation. I'm going to share a few stories, and I'm not trying to imply that one area is more important than another, nor the fact that the fact patterns only apply to one of the areas. I'd like you to think about how all of the stories are interrelated. So, without further ado, let's move on. Record retention. When I was in my mid-20s, I was living on the Kenai Peninsula in Alaska, and I was approached by a retired IRS agent. She wanted to know if I could help her with a client who had not filed tax returns for 6 years. The client was a photographer and had been awarded the state contract to fly out to all of the high schools and take all the high school graduation pictures. The client had been awarded this contract before, and he had done it for numerous years and was rarely at home. As Alaska is about 1/3 of the size of the lower 48, so it's pretty large, and he said he could not find the time to do any of his record keeping. The IRS had created a few of the missing years for returns, and they were possibly overstating the net income, and the client was adamant that his net income was wrong and needed help improving it. It sounded interesting, so I said yes. And we met at the client's house, and we went to the bottom level of a split-level home. Boxes were stacked to the ceiling with only walkways to maneuver through, and it took me a while to realize that that meant my role was to go through all of those boxes and do the annual record keeping for the 6 years. The process took weeks of constant labor, and eventually the client was able to file all of those tax returns, and the end result was a minimal amount of tax due, and much less than the IRS estimate. However, because the client did have a good idea about how the business was doing, he was pretty right on that, but he forgot about the significant amounts owed for the failure to file penalties and the interest on those penalties. This client had excessive record retention. When the project was finished, the backup documentation fit into 6 boxes, 1 for each year, and he resumed to be able to have the bottom half of his house again, and he was current with the IRS. At that point, he was taught how to maintain his records, and he is still in existence today and is using the same tools that he had received at that point. It's important to understand that the statute of limitations that the IRS follows in regards to tax returns. And so this is a quote from the IRS website. The IRS is allowed to pull your returns for audit going back 3 years from the time of filing, or 2 years after the tax is paid. They can go back 7 years if they find you did not report income that you should have, and it is 25% of the gross income you did show, and they can go back indefinitely if you do not file a return or if you file a fraudulent return. That was confusing. I'll try to clarify what I just said. If the IRS pulls your information for audit within that 3-year window, and they make adjustments to the gross income that you reported, and it was in excess of a 25% difference, they then can go back 7 years. I cannot stress enough that even if you can't immediately pay the tax owed, you must file the return so the clock starts ticking and you avoid the failure to file penalty. There's a copy of the standard record retention schedule that we use in the office. It's sitting on our table in the back, and you're certainly welcome to pick it up and take it with you when you go. Does anyone know what a compilation is? Compilation is a financial report that's issued by a CPA. CPA takes the information that the client provides, and we put it in a format that follows specific accounting rules, and there's always a letter attached to it. And that letter states something to the effect of, I, the CPA, am not responsible for anything that was in this financial statement, but you, the business owner, is. Most compilations will do a 2-year comparison, and they're usually created because the client has an SBA loan or local banks are requiring it. My firm completed a compilation for a client, and that compilation included a 2-year comparison, and there was a significant change in inventory for this client. They had also struggled with cash flow timing for the past couple of years. The client was a distributor with a warehouse and a small retail store location, and they used Petrie software for all aspects of their business. I met with the bookkeeper to gain an understanding of their systems, and we focused on inventory. They were not handling the inventory assemblies properly, and it certainly had affected their reporting and cash flow management. They would have to restock the components for the assemblies because the assembly component was not being done properly, and they didn't realize they didn't have that inventory in stock. This was greatly increasing their costs of their products, and we came up with a system for assemblies that would help reduce these errors. However, I also discovered another issue when I was there. The bookkeeper had told me that she always balanced the checkbook to the penny. And usually when I hear that from a bookkeeper or an owner, I usually can tell by the way their books are if they are telling me the truth. And I was not comfortable with the discrepancies in the inventory, so I thought I should look a little deeper at their bank accounts. I asked to see her systems for bank reconciliations, and it was quickly discovered that to the penny meant within $1,000 to her. Go figure. There was no evidence that she was doing any kind of fraud or intentional misconduct, but she felt that $1,000 was within a reasonable threshold. And the accumulated result of her within a penny was close to about a $15,000 swing in cash. No wonder the cash flow being so difficult for this client to manage. And once she understood the proper process of reconciling and how to manage the inventory properly in their system, it has really gone quite smoothly for them ever since. There are many areas that affect cash flow management, and in this instance, I'm only mentioning 2 in this above little example. As this slide indicates, internal controls help keep other goals in balance. Internal controls are all over our media for the companies that are publicly traded or companies with numerous employees. It's just as important for companies with minimal employees because the methods just need to be adjusted to work in their environment. The client is a law firm with several lawyers and support staff. And they had been in existence for at least 15 years when I was called in because their QuickBooks had apparently been acting up. Their main support person had tried to fix it and had convinced the owners that the best method of repair was to start over for the prior year. You can imagine the volumes of activity that had to be recreated. The support person was finally overwhelmed by month 3 and insisted that the software was really acting up, and I was sent in to troubleshoot the software. By lunchtime, I was sure there was more going on in this business than what the owners were aware of. I left and made arrangements to meet the owners and away from the place of business, and we decided that I should take a look at the support documents and information without that person around. I discovered that the support person had been stealing money for the past year, and there had been significant family illness in his family, and he was a 17-year employee, and he thought he could borrow the money and pay it back without anybody really realizing it. Unfortunately for the employer and the employee, that's not really how it usually works. The software acting up had been a diversion, and the owners were not educated on their software enough, so they trusted the employee's diagnosis. The employee had full access to the checkbooks and writing of the checks, which is not an uncommon practice with a 17-year employee. All owners had online bank access, but not one of them could even quite remember how to go in or to look at the checks. In the end, the employee had taken $250,000 in about a 9-month period. The owners did not prosecute, and this happens very often when this happens. The employee was fired and signed a promissory note for repayment. If some simple internal controls had been put in place and followed, it is unlikely that this theft borrowing scenario would have even happened. The owners could have appointed an additional person to look at the bank statements online and spot check a few checks and to look at the payees on those checks, because in this particular story, this employee had actually written the checks out to himself, asking for help, apparently, in his mind. Unfortunately, I've been involved in a few theft fraud cases over the years, but besides all that, I do believe that most employees are not thieves. Internal controls need to be put into place to reduce opportunities for people to be tempted when life throws them a curveball. And we all know that life does that occasionally. My last topic is a business plan. And most of you know what that means because you're here and you're already either in business or on the journey of starting your business. And I believe they are an integral part of your original organization. But I also think they have to be revisited after you are open to see if they are still, there are adjustments that need to be made or if they're still valid. I know a man, I'll call him Joe, and he had the foresight to seize an opportunity that was open to him because of a tragedy had happened. Joe was a big game guide in Alaska for a prominent outfitter who was pretty much a legend in that state. And this outfitter, was killed in a plane crash, and his hunting location permit became available. Joe had all of the proper licenses, the experience, the ambition, and the drive to open his own guide service. He created a business plan that he thought was perfect. He had been very practical and planned for very minor deviations. He had found angel investors, family investors, and his own capital, but the one thing that he didn't do was obtain outside advice. He had not contacted a lawyer, an accountant, a business consultant, no one to see if they thought that he might have been missing anything. Joe needed to organize, purchase, market, travel to safari club shows, and do his records, etc., all in a 1-year time frame. And everything was going forward as he had planned. And the first year went off beautifully, excepting for 2 little hitches at the very end of the season. Neither of these hitches were his fault, but they were devastating. His plane was in a crash in the wilderness. No one was hurt, by the way. But Alaska law says that it must be removed within a very short time frame, or there will be significant fines. And Joe had to pay for that. He also had to pay for an outside flying contractor to finish out his season for the last 2 weeks. And he would also have to pay for that. These were unexpected expenses. They were not in his original business plan, of course. And he did receive insurance money for this, but the money for the plane wasn't equal to what he had to spend, and it took about 8 months for him to receive that money back. Year 2, Joe had 2 more catastrophes that were beyond his control. The first hunt of his season was in August, and Alaska had experienced a volcano that dumped 1.5 feet of volcanic ash on the airport runway. Joe's clients that were coming from Mexico clearly could not get in, and they had to postpone their hunt for a year, which meant that their rest of their payment was going to be delayed for an entire year. The last hunt of the year for Joe also brought the worst early snowstorm in the mountains since 1910. Joe's clients had to be evacuated by helicopter, and of course Joe had to pay for that. There are many, many more details to this story, and I'm leaving them out because you're getting the gist of where it's going. Joe had many, many years of experience, and he never had witnessed any of these types of tragedies, and it certainly wasn't fun for him anymore. Joe was out of business by year 3. He had been sorely underfunded. If he had received counsel from the beginning, I believe that he would have been advised to adjust his plan to make concessions for the unexpected. I've covered the 4 areas I mentioned in the beginning of my presentation. They were record retention, cash flow management, internal controls, and business plans. And I have shared some stories that I feel have given some examples. These stories show extremes, but all businesses are faced with things that are not in the plan. My closing comment to you is to try to work on your business so that you don't just work for your business. Any questions? Okay, thanks.